Well, we always like to align, with where the markets are, and we don't want to surprise the markets. So the alignment, I think, is closer than it was before. But, we're going to set policy to do what we have to do to get back to price stability. So we've been raising interest rates. We've seen some of that working through the economy. We have seen some pressure off the inflation, but inflation remains too high. And as you know, coming out of the meeting last time, and the minutes showed earlier this week, that we're going to have to do a little more to get that back to price stability of 2%.
So I said yesterday, there's only one species of Fed official now, a greater or lesser hawk. Where do you put yourself in that, if at all? Are you...
Sorry about the audio glitch. It's fixed.
Average or median Fed funds forecast among Fed officials of 5 1/8, or are you higher or lower than that?
Yeah. So as I always said to you, I'd like to be known as an owl, not a hawk or a dove. But in any case,
for his wisdom.
Right, exactly. But it's not up to me to call myself that. I see a little more impetus in the inflation measures than my colleagues did, at least in December when we put out the last SEP readings, the Summary of Economic Projections. So I had my funds rate a little bit above the median in that projection, and I haven't really seen much change in my outlook for the economy since that time. So I see that we're going to have to bring interest rates above 5%. And we'll figure out how much above. That's going to depend on how the economy evolves over time. But I do think we need to be somewhat above 5% and hold there for a time in order to get inflation on that sustainable downward path to 2%.
But it's maybe significant. What you're saying is you haven't seen anything in the interim that causes you to change where your dot was in December.
No, I think I'm where I was because, remember, I saw a little bit stronger, more inflation impetus than the median did. And I also think that the labor markets, I'm not really seeing a trade-off between the hot labor market and inflation. I'm really focused on inflation. And what we learned over the last expansion, the pre-pandemic expansion, is that, the unemployment rate can be very low without necessarily spurring inflation. So I'm really focused on the inflation numbers. And I don't see that we have to have this trade-off necessarily between labor and price stability. In fact, I would say I'm greedy. I want to have healthy labor markets and a return to price.
My colleague Joe Kernan wants to ask you a question, but I want to just get one more before we get to him. The real question I want to ask you is, what the heck's going on with the economy? We're supposed to be an economy that was right now either in recession or on the way to recession. We printed 500,000 jobs for January. We had retail sales go through the roof. Is this all seasonal adjustment? Is this economy weakening, or is it ignoring the Fed when it comes to higher rates?
No, I don't think it's ignoring. I mean, we've seen some of the impact of higher rates. Certainly, if you look at the housing market, right, that's definitely clearly slowing, right? Manufacturing slowed a bit. Now we have some impetus that suggests that maybe it's not slowing as fast as we thought. So, if you had to sort of characterize what's happened, is coming into this year, there's probably a little bit more underlying strength than a lot of forecasters thought. But there's also some good movement on the inflation measures. They are coming down. It's just that the level of inflation is still too high, which is why coming out of our last FOMC meeting, the broad, consensus was among all the participants was that we're going to have to do more, which is why, the statement said ongoing increases.
Joe?
Thanks, Steve. President Messer, I'm just trying to get some insight into the idea of maybe 50 basis points and why it might have made sense. Why
it ain't happening.
Theoretically, it could still make sense. Like, I think if you know where you're going or are pretty sure of it and you need to get there, you might as well get there, is the argument. I'm wondering whether maybe everybody else is, or some people are more cautious, is because there's still data dependency. Is it possible that something happens more quickly in terms of a weakness in some area? So is there a reason to just do 25? Because if you need to do 50, you might and go higher than that, you might as well do it, unless you're leaving an opening for data to come in that shows that you didn't really need to go that high. Is that why you don't go 50?
Yeah, so Joe, it's a good question about tactics, about how to get to where we need to get to. I'm on the record saying that at the last meeting, I saw a good economic case for doing 50 because my view of the outlook hadn't changed, and I do believe we're going to have to move our policy rate above 5%, and a 50 at the last meeting would have brought the top of our target range to 5%. But other people on the committee had different views, and so that's what the value of having people sit around the table is. We come up with sort of a consensus view. Now, at every meeting, right, we do that same kind of analysis. We look at where the economy is, we look at the incoming data, we project out where we think the economy is going, understanding that the economy can evolve in different ways than expected, and then we set our best policy path. But I think the message coming out of the meeting was we got to keep going a little bit more. We've come a long way. We brought the funds rate up quite a bit, but we still have a little more work to do in order to ensure that we get back to price stability and making sure that we're committed and people understand our commitment is what's going to be able to get us back to price stability.
Do you support a 50 at the next meeting?
I don't prejudge, right? I go into the meetings and I'm going to look at the data and we're going to have a new set of forecasts, and that's going to help guide where we need to get to. But that's a tactical decision that we make at the meeting, right? It's got to be based on where we're going, how much the economy is slowing in terms of getting demand back in line with supply. And of course, the supply chain issues are also improving. So there's two things going on. Demand is moderating, and if you talk to our business contacts and our labor market contacts in my district, and I would submit in a lot of the districts, right, businesses are saying that things are moderating. So I know a lot of people think that, well, the data's lagged and you're only looking at the past. We have a lot of contacts across the districts that we talk to all the time, and that's very important because that's forward-looking. They're telling us what they're planning to do.
Andrew has a question for you.
President Messer, can you succeed at reducing inflation without raising unemployment? And on the unemployment front, what do you think a politically palatable unemployment rate is?
Yeah.
Well, this is an interesting labor market, to say the least. It's shown a lot of strength. There are structural things going on in the labor market as well as cyclical things. So I do believe that we can get demand down without seeing the same kind of rise in unemployment that in past slowdowns we've seen. And in fact, when you talk to businesses, a lot of them said it's been so painful over the last couple of years, and they've spent so much effort to hire people that they're going to do everything they can, even though they're anticipating some slowdown in demand for their output. They're going to do everything they can to keep people on staff so after we get beyond this slowdown and get back, on the path to price stability, that they'll have the staff they need. And in fact, some of our firms in our district are still hiring because they're anticipating that if we do have a slowdown, it'll be mild and then we're going to go back to a really healthy economy. So I do think that in this labor market, we can get back. We can have both. We can have healthy labor markets and we can get back to price stability. But I also think it's really important to know that if we want to sustain healthy labor markets over time, we've got to get back to price stability. So that's why I'm very focused on that aspect, right? We've got to get inflation down. We have to get back to our 2% goal in a timely way. And that's why I'm focused on that right now.
The problem, President Messer, is history is not really on your side. You as the Federal Reserve, not you personally, doesn't have a terrific track record of bringing down inflation without a recession. And this is the other side of Andrew's question, which is, do you think a recession is likely? Can you avoid a recession and still get back to your 2% target?
So my forecast is that growth will slow this year and be well below trend. I still hold to that forecast. So when you're that low, it doesn't take much of some kind of shock that you're not anticipating, which is the nature of a shock. You don't anticipate them. That can push you into negative growth for a time. But, when you talk to your business contacts, they're all sort of preparing for that kind of recession. But when you talk to one, they say it's going to be mild. So again, I think we can get back to price stability. What's different now is our commitment to getting back to 2% and all the things we've learned over time about how important it is to have that commitment, to communicate it, to be very clear about where we're going, right? As clear as we can without being prescient. We're not prescient, right? But to be very clear, and that's what's going to get us back to 2%.
There was a very important concept embedded in Joe's question to you, which is one about lags. We just had Jim Bullard on from St. Louis. He said, this is 2023, there are no lags anymore. I'm overstating what he's saying. Do you think there are lags that are yet to hit this economy that will, I guess, offset the need for you to go quite so high?
So there are two things. One is we have been very much different this time in terms of communicating where we're going. So what you saw, right, well before we made that first rate increase back last year, at the beginning of last year, right? Markets had already priced in some of that because we were communicating in advance. That doesn't detract from the fact that it does take time for those rate increases to go through the economy. So the financial markets reacted, but it still takes time to get through. And we saw that in the housing market. It didn't react immediately. It took, even in the housing market, which is very interest rate sensitive, it took some time. Those lags are still there. So I do believe that, we're going to start seeing, more of what we've done in the past affect the economy. But nonetheless, if you just look at what's going on in the economy now, the strength, the fact that inflation still remains high, the fact that parts of inflation are coming down, but other parts, including the important service sector, ex-shelter, have not moved. We're going to have to do some more, but we are making progress on that path.
Joe?
Yeah, President Messer, if energy prices, if something happens there, I don't know, we're using the SPR, take your pick on what could cause a spike there. And I know you could do core maybe to try to factor that out, but then it seems like it filters through to everything else. If that's why inflation stays stubbornly high, would you continue to work on slowing the overall economy when really that's not really why we have the inflation? You can't really address the energy supply problem. So it just seems like that'd be a bad reason to go much higher than you need to go in terms of tightening for something you can't really control.
So, Joe, it really depends on what's causing that, the energy prices to rise. If it's because demand is still well outpacing supply, then we're going to have to think about what that means in terms of the path of inflation. If it's a supply shock, which is typical what you're talking alluding to, then you're exactly right. We have to look at what's the underlying inflation rate. What are inflation expectations doing, which are all important, anchoring them, keeping them at 2% over the long run. So long run inflation expectations are still reasonably well anchored. And so we'll have to do that judgment. But you're exactly right. This is a risk management kind of a process that we have to go through. So it really depends on the source of that rise in interest rate, rise in oil.
We're going to have to go real quickly, but we've been giving every Fed official we're talking to a hard time about the following. You guys had it wrong when it came to the inflation and policy. Inflation surged up and the Fed was on the wrong side of that trade. Why should we have confidence now you have this right this time?
Well, we're just like every other economist trying to do the best forecasting job we can. I think we reacted well in terms of once we agreed that this inflation impetus was there, it wasn't going to dissipate quickly, that we were really going to take action. We did that. And we are very committed to getting back to price stability in a timely way.
All right.
President Messer, thanks for joining us. And
Okay, listen to this. Look, I'll talk about what she just said in a moment, but this was scary. Okay, you ready for this? Look at this. Hey, quick note, Ricky Carruth on YouTube made a phenomenal review of his shadowing experience with me. So if you're interested in that, learning more about me or my personality and what I'm like in real life, or those programs on building your wealth, linked down below, use that flash sale. We've got a 69% off discount for you on all the programs on building your wealth. The most common right now are 0 to millionaire real estate investing and stocks and psychology of money, which come with trading, fundamental analysis, long-term analysis, my thesis on the market, Q&A with me and daily market open live streams, and in the Elite Hustlers course, we've got custom live streams on the weekend. Never seen this before. So obviously the Fed officials, they regularly bring up inflation expectations. And I've never seen this before. This is the first time I've actually seen this on this particular chart. And it's not just this chart, it's also when I zoom out even more. But let me explain this to you because it's kind of scary. And then we'll talk about what Mester just said. But and it's scary because of how uncertain or how much uncertainty it creates. All right, so what I want you to think of first is this blue line right here are inflation expectations. This white line are financial conditions. So the higher the white line goes, the tighter things are. Think about it as like 10-year treasury yields. Interest rates are more expensive. The market is crappier, right? So things are tougher for businesses and expansion when the white line is up. And when the blue line is down, it suggests disinflation or deflation even, right? So generally what you see is as financial conditions tighten, the market's expectations of inflation go down. It was true over here in 2018. It was true in the pandemic. It's pretty much always true. In fact, let me show you pretty much always true by zooming all the way out to when this financial, this sort of tightness chart started, or the break-evens chart started over here in the dot-com bubble, you can kind of see the inflation expectations go up over here on the left when we see financial conditions come down. In Great Recession, you see financial conditions up, and you see break-evens down, okay? All right, so we got that. Now, what is happening that I haven't seen before, and this is a little odd because it's sort of breaking the tradition of what we usually see, and we know it's something the Federal Reserve really pays attention to. Okay, ready for this? Look at this chart. Now look on the far right side. Look at this. This is so weird. Financial conditions are tightening at the same time as break-evens are moving up. That's bizarre. Usually break-evens come down as financial conditions loosen. In fact, you can kind of see this loosening over here, and we loosen expectations over here. We had but I mean, I can't say we have much of a correlation between some of these. So there's a lot of, I guess maybe the way to look at this, because as I'm looking at this a little bit more, the way to look at this is it's super odd and volatile right now relative to what we've seen in the past, right? Generally, again, in the longer term, as these conditions fall, break-evens rise. As the conditions rise, break-evens fall. But right now, we're having this sort of bizarre moment where yields are going up, expectations for the market tightening or getting higher, but inflation expectations are actually also rising. So it's kind of bizarre because it somewhat, the only implication I could pull out of this is that the market is suggesting we need even tighter financial conditions to actually keep this downtrend moving on the break-evens. Now, that somewhat aligns with what Loretta Mester says, which, look, we've got to get above 5.1%. And what did she really tell us? Well, one of the big things that she reiterated was something that we've heard about in the FOMC minutes, which is that, look, the housing market is slowing down and manufacturing is slowing down slightly, but not as much as we'd like. Notice that kind of combination there. Manufacturing is slowing, but not as much as we'd like or expect. Housing is slowing. And then kind of like, yay, that's what they want, right? They're trying to engineer a housing slowdown because the housing slowdown is exactly what reduces demand and spending, and that brings inflation down. She also is one of the first folks here. She was supposed to be basically the big bear who's going, 50 basis points, 50 basis points. Today she's like, I said 50 last time, but I don't necessarily have to say 50 this time. I just wanted to say 50 so we get closer to the high-end rate of 5%. Well, I mean, if they do 25 basis points in the next meeting, they'll have the high-end rate. Because remember, it's a range. When they raise rates, they give us a range. So if we're at 4.5 to 4.75 now, well, if we raise another 25 BP, what do we get? 4.75 and 5, right? So you can achieve what she wanted to achieve last time, this time with a 25 BP hike. That just reiterates what I've been saying over the last few days, and quite frankly for a while, that I think it would be ridiculous for the Federal Reserve to go 50 now, even though that's probably what they should do. They'd be shooting themselves in the foot in terms of credibility for what they have left anyway. But let's put some of that aside. What else did she mention that was quite odd, or maybe should I say different, for Fed folks? Well, she talked about basically, without using the words, the Phillips curve being broken. Now that's really interesting because generally, in order to bring inflation down, you have to force unemployment, especially if there's a wage price spiral. Wage price spiral, you have to kill the economy, force employment, bring things back to normal. 1980s all over again, Paul Volcker, right? Okay, fine. So since then, and even prior to that, traditional Keynesian thought, and via even the Phillips curve, which was created in the 90s, well after John Maynard Keynes and his economic theories. But anyway, this Phillips curve was this idea that, hey, look, in history, we always have to force unemployment to bring inflation down. And she made the argument here that, no, we don't think so. We think there are things happening in the labor force that make, quote unquote, this time different. Because people aren't laying people off because they went through years of struggling to find people. So maybe if everybody's just sort of patient and walks through whatever this is, whether it's below trend economic growth or a shallow recession, maybe as long as we can get through the pain of last year and this year, and we suffer with our flat earnings or our negative EPS for a year or two, and then we basically, as American Express says, spend through the recession and use the savings we built up to sort of survive and get to the other side as businesses and individuals, well, then maybe things just won't actually be that bad, and we don't actually have to force unemployment up for inflation to come down. That's the argument she just made. I mean, if you go back and just rewind and listen to it, she was pretty clear that we don't need to break unemployment. The unemployment rate can be very low without spurring unemployment. That stands in complete contrast to what the Federal Reserve basically has been teaching for decades, which is this idea that the Phillips curve says if inflation is low, the unemployment rate, or to get inflation down, the unemployment rate must go up, because then, in other words, labor earners have less pricing power, and if labor earners have less pricing power, they bring inflation down, because you basically have the opposite of a wage price spiral, right? Labor gets cheaper as it competes for dollars, and that enables prices to come down as company margins can rise in excess maybe of even their labor cost savings. And so their need to raise prices evaporates, and then pricing comes down, top line pricing comes down. So that's where sometimes pricing power gets a little bit tricky, because we generally think of pricing power as, oh, they can raise prices. Well, look, Tyson Foods might be able to raise prices, but if their margin, if they raise prices 10% and their margins are compressing 20%, well, they're losing more money, right? Even with higher prices. So really, like, ideally for a company, you can actually reduce prices and your costs go down even more, because now you could be more competitive against your competitors. You could be more competitive, sell more of your product, and boom, you win, right? Like you end up making more money at lower prices. That's the ideal scenario. So I think it's interesting. My big takeaways from what Loretta Mester said were, inflation expectations are still anchored, which I agree with her, but they're starting to do something weird. It might just be short-term volatility, and that the market is now expecting that we have to tighten financial conditions even more. But sure, I suppose if you look out and zoom out more, sure, they look anchored, but I don't like this recent rise we've had in inflation expectations. I think they're going to pay attention to that. And if we have to bring financial conditions back up to these levels, well, that's going to mean 10-year Treasury yield at 4.5%, and real estate gets hurt even more, right? Her taking this strong stance that the Phillips curve is broken, we don't actually have to force unemployment because people are hoarding employees, also quite interesting. And her reiteration once again that the housing market essentially has to keep coming down, which is what we've heard Jerome Powell say at the beginning of last year, the middle of last year, and reiterate in the minutes, really to me suggests the Fed wants 10-year Treasuries up. They want real estate down. That's the goal of the Fed, and they don't really care what happens in the stock market in the short term. We'll see, but that seems to be what Loretta Mester suggests. And it's also interesting that she basically just walked back this idea that she's 50, 50, 50. She made it clear, hey, like, I was 50 to get the upper end to 5%. Well, guess what? In the next meeting, you can get the upper end to 5% with a 25 BP hike, right? After all, 25 plus 25 is 50. So I have to say, if she's a hawk and she's listening to her contacts as leading indicators, if she's considered a hawk, this was bullish. And I don't think I'm trying to be like, put the bias on or whatever, and I want it to be bullish. Like, if this was hawkish, I tell you, if she's a hawk, that was bullish. Whether that's the leading indicators they're seeing or the leading contact stuff, whatever, right? Their teal books and their economic reports from their industry contacts. Whatever you say, that was not a bearish Fed talk. And she was supposed to be one of the bears that was driving the stock market down over the last few weeks here over this fear.